You know, back in 2008, the entire world economy came this close to just dying. Now, the official story usually blames the big banks, but that's really not the whole truth. Today, we're going to pull back the curtain on the real architects of the meltdown, the supposedly trusted gatekeepers whose golden seal of approval turned financial poison into gold. This is how they did it. Look, this isn't my opinion. This is the official conclusion from the US government's own investigation into the crash. It is an absolutely staggering accusation. It places a very small, very powerful group of companies right at the epicenter of the whole thing. The government itself is saying, without them, the crisis simply couldn't have happened. So the question is, who are they? All right, to really get how this all went down, we're going to follow the evidence. We'll start with the mystery of what I'm calling the AA implosion. Then we'll uncover the financial alchemy that created these toxic products in the first place. We'll identify the gatekeepers who held all the power, expose their trillion-dollar motive, and finally, we'll ask the big question, has any of this actually been fixed? Okay, let's set the scene. The year is 2008, and the world's financial system is in an absolute free fall. You had these titans of finance, firms like Lehman Brothers that have been around for over 100 years, just vanishing overnight. Trillions of dollars in wealth, gone. But underneath all that chaos, there was a deeper mystery, a puzzle involving investments that were supposed to be the safest things on Earth. This number, this right here, reveals the unbelievable scale of what was happening. Of all the mortgage-related securities that the agency Moody's rated AAA, that's their highest, safest possible rating, in 2006, a mind-blowing 73% were later downgraded to junk. Just think about that. 3/4 of the investments they certified as rock solid turned out to be completely worthless. And that brings us to the central question of this entire explainer. How does that even happen? How do things that are professionally certified as being as safe as government bonds just become toxic waste almost overnight? Well, to solve that, we need to look at what was actually inside them. The answer lies in a kind of financial engineering that one Nobel laureate didn't call innovation. He called it alchemy. It was the process of turning financial lead into gold, or so they thought. So the weapon of choice in this crisis was something called a mortgage-backed security, or an MBS. The idea itself was pretty simple. Wall Street banks would buy up thousands and thousands of individual home mortgages, bundle them all together into one giant package, and then slice up that package and sell the slices to investors. The problem, though, was the quality of the loans they were bundling. And this is the crucial part, this 3-step recipe for disaster. Imagine you're making a smoothie. Step 1, you take thousands of risky, low-quality, frankly terrible mortgages, the financial equivalent of rotten fruit. Step 2, you blend it all together, and then you pay someone to slap a grade A, fresh and healthy sticker on the cup. And then, step 3, you sell that smoothie to pension funds, to global investors who are legally required to only buy healthy grade A products. They trust the sticker, right? They have no idea what's really inside. And this just brilliantly illustrates the whole deception. The entire point of the process was to take F-rated risk, disguise it with a whole lot of complexity, and then use a rating agency's stamp of approval to label it A-rated safety. But this kind of magic trick, this alchemy, it couldn't have worked without a willing accomplice to provide that magic stamp. And that brings us to the accomplices in our story, the companies whose entire business model, their very existence, is built on one single thing, trust. We're talking about the credit rating agencies. Now, the ratings world is dominated by just 3 names, S&P, Moody's, and Fitch. And these weren't just any old private companies. They were officially recognized by the US government as, well, they have a fancy name for it, NRSROs. This special designation basically outsourced a huge chunk of financial regulation to them, giving their ratings the force of law and making them the ultimate gatekeepers of the entire market. And when I say they dominated, I really mean it. Together, these 3 control about 95% of the entire global ratings market. This is not a competitive marketplace. It's what you call an oligopoly. For any company or bank out there wanting to issue a new security, there was basically nowhere else to go. And that AA rating they could give you, it was a golden ticket. It wasn't just a suggestion of quality. For these huge pools of money, we're talking pension funds, insurance companies, government regulations required them to hold only top-tier investments. So this created a ravenous, legally mandated trillion-dollar demand for anything with an AA sticker on it, no matter what was actually inside the box. So we have the weapon, we have the accomplice. Now for the most important part of any investigation, the motive. Why would these trusted gatekeepers risk their entire reputations to rate junk as gold? Well, the answer lies in a huge, fundamental shift in how they got paid. See, for most of their history, the agencies worked for investors. The people buying the bonds paid for objective, tough ratings. But then, in the 1970s, everything flipped. The agencies figured out they could make way more money by charging the banks that were issuing the bonds, the very same companies they were supposed to be policing. This became the issuer pays model, and it created a catastrophic conflict of interest. And this right here lays the core problem bare. Under the old model, your incentive was accuracy, because you had to serve the paying investor. But under the new issuer pays model, your incentive is just to please the client who's paying your fee. Banks could literally shop for the best rating, playing the agencies off each other to see who would give them the highest grade and guarantee them the most business. I mean, it's a structure that financial experts and regulators all agree creates an unavoidable, inherent conflict of interest. It's like the referee is being paid by one of the teams. How can you possibly expect the calls to be fair? And during the housing boom, this wasn't some theoretical problem. It fueled a frantic race to the bottom. The fees on these complex new mortgage products were enormous, and the agencies fought tooth and nail for market share by giving the banks the triple ratings they needed. Accuracy took a backseat to revenue. It's as simple as that. So after the crash, after trillions in losses, and all the official inquiries pointing the finger directly at the rating agencies, what did we do to fix this clearly broken system? The main response in the United States was the Dodd-Frank Act. Now, it created new oversight offices and made it easier to sue for bad ratings. It did a lot of things around the edges, but it completely shied away from tackling the one problem that mattered most, that inherent conflict of the issuer pays model itself. And you have to remember, this wasn't just a US problem. The power of these agencies went global. After the 2008 crisis, their downgrades of entire countries, like Greece, Portugal, and Spain, helped ignite the Eurozone debt crisis. That shows you their power to shake not just companies, but entire nations. So, what's the verdict? Well, despite new regulations, despite all the public outcry, the two core problems that caused the crisis, they remain completely unchanged. The issuer pays model is still the global standard, and the big three still control 95% of the market. The fundamental conflict of interest is still hardwired into our financial system. Which leaves us with a final and pretty unsettling question. The exact same conflicted structure that enabled the 2008 meltdown is still in place today, rating a whole new generation of complex financial products. So, have we learned our lesson and truly fixed the system? Or have we just reset the clock on the next crisis?
So while markets rise and fall, systems like this quietly move billions behind the scenes, hidden from the public, hidden from scrutiny, and sometimes hidden from the law itself. Because in global finance, the most powerful forces are rarely the most visible. And this is just one of the systems used by the unseen elite.